Alright, so I'm gonna do one other video here this evening. It's still November 19th, and I'm going to be using Paint to define mitigation blocks and also define the difference between a mitigation and breaker block. So I'm going to start with a bearish breaker, which would look like this. So, second. Okay. You'd have this kind of pattern of like price looking as if it is going to continue higher. So we have this high and we see price actually trade above that. Okay. It retrades into that, not trading to the previous high yet. All right. And then does this little motion where it makes us think that it's going to continue in the opposite direction. And then we see an aggressive run below this low that formed here, which creates a shift in market structure. And when it returns to that is when we have our bearish breaker, and we could be a seller. All right, and then this one would be diagonal, by the way. It's just my drawing skills, right? It would be, of course, more like that's probably as far as I can get it, right? That when it trades back to that low, we don't have it. All right, obviously the same thing for a bullish breaker, right? So you'd have like this price action that's like, we see like a low form, a rally, a new low form. We then see that sell side liquidity taken. All right, you see price look like it's going to continue doing what it wants to do. All right, see start to go lower again, and then all of a sudden with this high here, we see price aggressively run that. All right, after we have that aggressive run, we expect price to return back to that previous high. That's where we would be a buyer. This would be, the idea would be that, we expect to see higher prices afterwards. So how is this different from a mitigation block? Well, the very first thing here is that the beginning to a breaker is a low with a lower low, or a high to a higher high. In other words, buy stops must be taken with that. Now, when we look at a mitigation block, we have someone who, say we're in, upwards price action. That's, we've seen higher and higher prices, right? And so we have a high form, okay? And after that high forms, we have price actually trade back into that range and then fail lower. We see it aggressively move lower. So in other words, it's a failure swing. We then have this here. We mark out that low from here to here. Okay, and that is then our mitigation block. And we expect price to trade into that before continuing lower. Now, when it breaks below this low, it's the same thing. Mark that out. Okay. And from this high then to this high, we expect price to retrade it. Breaks low again. Of course, this is getting sloppier and sloppier. But he mentioned it forms like a step ladder. So I want to explain that. Okay, new low, new high. Here's our mitigation block. Anywhere in that range, price returns. We could be a seller all the way until we reach our level of institutional reference point or bearish support. And that's for both of these, by the way. Both of these are going to form at a old institutional reference point, such as like an order block, or they're going to form at a old level of support. So be it like price actually trading below an old low. All right. Now I'll do this. This will be a little bonus I'll throw in there, which again is the mitigation block. Okay. So we'll have price action. I'm going to do this with actual lines instead, right? So say these lines represent the body, okay? So overall, we're seeing higher price after higher price, higher prices, overall, okay? And then eventually we have this swing high formation. Okay, which is a candle with a higher. So that, and this represents, by the way, these lines represent a intermediate term uptrend. Okay, you know that we've seen price continuing up because that's where you know you find these. So, anyways, regardless, we see that form. Okay, and then we see price. Just put some like black candles here. Okay. So price trade away a little bit. And we see price return to it. But when price returns to it, it stays in the range of the actual wick. This line here represents the wick. Okay. So price trades into the range of the wick to the high. Okay. And it doesn't trade higher. If it trades higher, then that would not be a rejection block. But we have our swing high, it trades into the range of the actual wick, and then the idea is that this is distribution. So they are distributing their positions that they, you know, bought down here to buyers who are willing to buy them at a higher price right here or above, you know, this candle's high. So in other words, a level of buy side. And afterwards, we would expect price to continue lower. Yeah. Okay. Maybe not aggressively, but again, you know, this is just to test my understanding, to externalize it and understand it. And again, that would be in a intermediate to medium term, you know, downtrend, or in that, sorry, that one would be an uptrend, but it would be the same thing for a downtrend. So you're ultimately looking for a swing high. The candle has to have a large wick, all right? And then with that candle that has the large wick, you expect price to trade into that, but not higher than that after a significant impulse move in price action, be it higher or lower.